Good morning, everyone. My name is Prasad Padmanabhan, CEO of AICB, and welcome to this joint webcast between AICB and PwC Malaysia on digital banking, Malaysian banks at a crossroads. This is a second of a five-part digital banking series with PwC under the AICB's Empowering Bankers webinar conversations. Thank you for joining us today, and we hope you will continue to participate in our webinar series as we do our best to bring greater online sharing and knowledge to our members during these challenging times. Now, a few housekeeping details before we start. If we could move to the next page, yes. The microphones of all participants are automatically muted to minimize disruption to the sessions. This webinar is also an interactive session. So if you have any questions, please submit your questions online by clicking the Q&A tab. Please do introduce yourself by stating your name and the organization that you represent. We will do our best to try and answer as many as we can. You may also use the chat function to provide comments and feedback during the session. Kindly note the session is recorded. The speaker's presentations will be emailed to you and the recording will be available on the AICB member portal. If you have to leave the webinar session, please select Leave Meeting on the bottom right of your screen to do so. You can still rejoin the webinar session if it is still in progress. Now, setting some context. Some of you may have joined our previous session on digital banks, why will they matter, where the discussion centered on the advantages that digital banks have over traditional banks and how they are changing the global banking landscape. In today's webinar, we continue these significant discussions on digital banking in Malaysia with a focus on strategies that financial institutions need to consider and adopt to stay relevant and compete in the banking and fintech landscape, the right customer value proposition, partnerships between fintech companies and existing banks, what traditional players need to do to stay ahead of the curve. Without further ado, it gives me great pleasure to welcome our speakers for today, Michael Foong, Group Chief Strategy Officer and Chief Executive Officer, International Maybank Group and Chartered Banker, Dr. Paul Francis, Financial Services Strategy Director, PwC Malaysia, and Yennie Tan, Deals Partner, Deal Strategy, PwC Malaysia, all of whom are valued experts in the area of digital banking strategies and implementation. May I please invite Paul to begin the session with his remarks and presentation. Thank you.
So thank you, Prasad, for the introduction, and thank you very much for the opportunity to speak with you today. If we go a page down, please. You know, globally, we're seeing that virtual banks are actually starting to dominate and challenge the incumbents in a lot of markets around the world. We're seeing that they're able to capture, significant market shares. And when it comes to things like the application download and usage, they're actually winning the battle against the conventional banks by a significant margin. But it has not been easy. These countries over here where the banks are actually getting the green and the maturing, have been a 5 to 10 year journey to get to this point. And there's a lot we can learn from what they did on that journey, what mistakes they made and good decisions they made when we're thinking about how we can actually fast track digital banking in Malaysia. Probably one exception is China. China has come from the back to the front very, very quickly, but it's a very different proposition if you're Alibaba and you've got 800 million members on your platform, which is over twice the size of the US population as a whole. It's easy to take that customer base and actually convert that into something viable. So the key theme, I think, in terms of accelerating is actually getting into a platform or an ecosystem where you can actually access the customers and activate them. So that's a key theme in terms of being successful in banking strategy. So page down, please. What we're actually now seeing is a second wave of countries opening up their banking system to virtual banks. And most recently, we see the licenses being issued in Hong Kong, 8 of those. And Singapore is also putting out the applications in the process now for 5 licenses. This time next year, I expect to see another bubble here, which is Malaysia, with another 5 licenses. And typically, the strategy for these companies who are trying to get the virtual banking license is to target the weak points in the existing financial services sector. It's around addressing underserved segments. It's around looking at pricing that's not necessarily favorable for customers, account keeping fees, transaction fees. It's also going to the core of the customer experience. It's looking around taking away the friction that you have by going to the branch. It's around providing a much more rich technological sort of interface that people have come to expect from other industries that banking is not necessarily being able to keep up with. And it's also around exploiting a mistrust in some sectors around working with the traditional financial services sector. Now, for Malaysia, it's critical that we actually look at that first one on underserved, because Bank Negara has actually said this is the focus of a virtual bank in Malaysia. And this is good for the underserved, but it's actually a challenge for the banks because these people are going to be hard to service and they're not necessarily going to have the money to buy a lot of different things that you'd want to sell them. So getting that pathway to profitability is a critical step in being able to make your bank sustainable. So page down, please. So, last count, 50, 60, 80 people around in Malaysia are actually thinking about going for the banking license. And in many cases, the decision to go for a banking license is driven by what I as a company can do with that license. So if I'm a smaller incumbent bank, I would be worried in some respects around what is digital going to do in terms of challenging my current positioning. So I might want to defend my core business. At the other extreme, if I have that big customer base like Alibaba, or I'm a tech company, or I have these capabilities, it's around saying, can I actually reinvent my company into something new and pivot my business model into financial services? So there is actually quite a few different rationales or justifications why a company is actually interested in going for license. And this is good, it gives the interest, but ultimately, I think this is actually the wrong question. If I'm looking to go into the virtual banking space, it's not around what I can do as a company. It should be actually around what can I do for the customer. So if we go page down, if we're thinking about virtual banking, if you want to win, there's actually really 5 questions that I'd be wanting to ask myself and before I go any further. And I'm going to break this up a bit. Yennie's going to talk more around building the proposition. One of the key partnerships is around building the capabilities through partnerships. But at the core, you need to be able to answer the question around how am I going to create value with the virtual banking license? What are you going to give that's better than the alternative that's going to make it attractive and being able to capture customers? The second one is actually how do I differentiate myself? So I recall a bank in Australia, probably talking the accent I'm from Australia originally before moving up to Malaysia 10 years ago. It was an entrant and it had that tagline saying, money doesn't grow on fees. So they saw this point where they could actually attack the fee income of the major banks, and they offered unlimited withdrawals, no transaction fees, no account keeping fees, no minimum balance fees. And they positioned themselves as being a value bank. So tick, it definitely does deliver value. And that was really clear and easy to enunciate, and the entire branding and strategy was really built around it. But the challenge is it's not differentiating. And we've seen in Hong Kong, in the latest round of entrants, these virtual banks are just coming online now. Some of them have actually taken the same approach. And what have the incumbents done? They've actually cut their fees. So it delivers value, but at the end of the day, it's not defensible and you can't differentiate yourself. So they've answered half the equation. I think actually my inspiration for the second one is coming out of some of the experiences we have in the US, where we have virtual banks that are working in conjunction with conventional banks, driven by the regulatory regime. Imagine a different situation. I have a customer that you see their transaction history. You know when they're paying their telephone, you know when they're paying their rent, you know when their salary comes in. And I see that they pay their bills regularly, so they're a good risk. I also know that in the 4th week of every month, they are going to run short of cash. And I know that I need to give them $150 and that will be enough to get them through into the next pay cycle. And in the moment, you get an offer saying, here's an additional set of funds to draw down on. And particularly for this bank, it's really interesting, is that they've looked at the culture and they said, you don't have to pay anything. It's free. All you have to do is, if you're happy, is you give us a tip. So that works really well for the US culture, which has got tipping embedded in it. And they actually have a very profitable business based around this free inverted comma model. But you think about what's required to deliver on that proposition. It's a really deep understanding of the customer behaviors. It's a really different understanding around the risk profile that a conventional bank may miss. And finally, it's actually a very creative approach to pricing. They have done this in California and in Texas, and they've actually seen there's actually different behaviors for different states. So it's also then around the agility to adapt and modify the offer to make sure it works in the locality. That is really valuable, and it's really differentiated, because anybody trying to replicate that has several years of work to catch up on them, unless they've actually been building the same capabilities. So I think the real challenge is creating value is clear, but differentiation is hard. Yennie's going to talk about how do you put together all these capabilities to pull off a really strong differentiated proposition like that. But the last thing I would actually want to do is the last question. Virtual banking is a great opportunity, but with COVID pushing it back and a long application process, the question I'll be asking myself as an incumbent, or whether I'm actually want to get into space, is what can I do now? Why wait until the virtual banking license comes out in a year and a half, 2 years' time? Because I can capture some of the opportunity now. So I wouldn't be waiting for 2 years. I'll be thinking, what can I do today, whether it's through partnerships with existing banks, or whether it's a bank digitizing themselves internally and meeting the challenge of virtual banks. So with that in mind, if we page down, I want to talk about a bit about value proposition from a banking side. And this is in part driven by lots of different conversations with people thinking about getting into the space in Malaysia, but also around a reasonable amount of research around the region and talking with people who actually worked in virtual banks globally. So page down. So the first point, and I think this is actually really a critical thing, is being digital is not enough. It is merely the right of entry to play in the game, is table stakes. But it has to be built in from the ground up. And this is probably the greatest advantage that a virtual bank has over a conventional bank, is that they can reimagine what is possible. So MyBank in China, it uses real-time payments data and uses over 3,000 variables to do its credit scoring. And it can actually then make a decision in less than 3 minutes. If you compare and contrast that to the conventional banking system, which looks at your current holdings, your previous history, it's a very radically different approach to actually getting to the answer. For Kakao Bank in South Korea, they fundamentally tried to take all the friction out of the KYC onboarding process, and they've actually been able to reduce that. And it's mobile only to drive the low cost. DBS, DBS, a major bank in Singapore, regional bank. It's actually addressed the challenge of digitizing itself with a quite interesting way. It actually went to India and said, in India, I'm going to operate a totally different business model that has no connection realistically to my core model in Singapore. And with 60 people, they have several million accounts, and it's actually really quite an efficient operation. It's paperless, it's branchless, and it has no wet signatures. And they're actually using things like AI to drive a lot of decisions. So it's hard to challenge your own way of working in your home countries. So DBS has said, I've got a playground over here where I can actually reinvent myself completely. And now they're looking around taking that model into other markets like Indonesia. And Starling Bank in the UK, it actually has really good analytics to actually look at spending insights. And that provides it both to the user, but also to the bank in terms of making decisioning. So as a starting point in building a customer value proposition, you need to use technology to reinvent customer experience. It's not a process of taking what the bank does today and putting an additional layer on it. It's actually breaking it apart and reassembling it into something new using the digital capability. The second thing is actually around keeping the cost of operations low. The bank branches today would cost anywhere from 40 to 50% of the total staff costs. If you can avoid that, you're actually putting yourself into a really strong competitive position. The final two things actually go to around culture. Is that really a virtual bank has to be ready to soft fail. I wouldn't say you want to fail given that you've got other people's money, but you need to be able to make decisions and try things that may not work. And for example, I was talking about the US AI-driven offer. They had very different offers for different states. So actually having that agility to adapt and working with the AI and machine learning to drive insights is critical to put yourself apart from your competitors. So page down. But I also think that the first couple of years, unless you're lucky enough to have those 800 million customers from Alibaba, it's actually a tough road to get to profitability. And as a new bank, you're going to be facing some challenges. So if I was thinking about my low fees, unlimited transaction model for underserved customers, there is banks that have tried that and they found it very, very difficult. So N26 is a German bank. It works across the entire EU because of the open borders they have there. But they started off by having low balances, unlimited transactions, and no fees. And since they didn't own the ATM network, they had to pay every time somebody took money out of the system. So if you can think of a case where somebody's got 20 euros and they have to pay 50 cents for every transaction, and they're taking out €5 at a time, you're not going to make money very quickly. So they had to go to an acceptable use policy because they found that people were using the feature in their system both for money laundering, and also they had low value customers who were taking out incredibly small amounts in transactions. The second thing that comes out as a new bank is you're likely going to be targeted, and you can't compromise on security and the cyber security. So there were some examples where people had lost significant amount of money from the N26 account, and because they were targeted by phishing and through cyber attacks. But they're unable to get to the bank and actually get the bank to help them resolve the problem. So even if I want to have low cost, I can't compromise on the fundamentals such as security, and I can't compromise on customer care. The page down. So I think that starting point for most banks is actually looking around payments and deposits, but that's not going to drive profitability long term. And if you're thinking about getting into the virtual banking space, you need to have an end game in mind where you're actually trying to take the customers that you've acquired and create value. So we're looking at examples around the world is in Brazil, in South Korea, UK, these banks that are actually doing quite well today are actually started with 1 or 2 products, but they've expanded over time into a full set of features. So in some respects, it's not should be around virtual bank. I think it should be around virtual financial services. And for Malaysia today, if I'm thinking of the underserved, they're underserved on banking. They're also underserved in health, they're underserved in insurance, and they're underserved in retirement savings. And I think at the end of the day, it would also be valuable if they had a real better understanding of financial literacy. So in terms of meeting the challenge that Bank Negara has set, start with banking, but actually work to answer the financial needs of the community and the person as a whole. So I'm going to hand over to Yennie, who's going to take us through, once you've got this great proposition that you think are going to win the market, how can you pull together the coalition and the people together to actually deliver on things? So thank you very much.
Thank you, Paul. Can we call upon Yennie now to present?
Yes, thank you, Prasad, and thank you, Paul. Good morning, everyone. My name is Yennie. I'm a deals partner with PwC. Today, what I'm going to share is just some of my observations and experience, having worked with a range of investors, corporates, and banks, evaluating various tech and platform businesses over the years. Next slide, please. So in my conversations with clients today, the top 3 questions that keep featuring, that I'm being asked by clients today is, number 1, can digital banks actually make money? And the second question would be, what would it take to actually become profitable? And the third question is, why do we actually need to partner to apply for a digital bank license? I think today, what I'm going to share with you is it's basically some observations that we have seen across the region, as well as from some of our direct experiences working with clients. And there are a number of sort of key success factors that have contributed to the success of many of the successful tech startups today, which have actually become huge platforms. And I think the first important factor is being able to actually create that very distinctive brand in the market. And the second, having an enormous amount of traffic and active user base wanting to use your platform and coming back. And the third is it's truly understanding your customers, who they are, what do they really want, and ultimately being able to improve the UX experience. For the successful players, what they have done well is to be able to address the critical pinpoints of that segment of the market that they were targeting, and to be able to propositions to fulfill an unmet need. And these could be the underserved, they could be the macro SMEs today who are unable to access a cheap and available financing, or they could be the underbanked, and they could even include the millennials, the youth, basically anyone who's unable to access financial solutions through the conventional banking system. So companies partner and form consortiums for various reasons, as we have seen across the region, starting with Hong Kong and Singapore. Many of the partners, many of the players have come together, formed their consortium, and brought about several partners who were able to contribute differently, and we're going to speak about that in a bit. As with each of this, what it shows us is that having partnerships do have a strategic benefit, whether it is to access a market, a customer, or perhaps just leveraging on the superior technology capabilities. The next slide, please. So here are just some examples that I wanted to share in terms of what we have seen across a range of partnership consortiums that have been formed in Singapore and in Hong Kong. I think unfamiliar to us is Grab, the super app that has dominated Southeast Asia region, starting very much with finding a solution to address the transportation needs of the region, and partnering together with Singtel to be able to access the huge telco customer base. And in this consortium, we understand that Grab will take a 90% equity interest to drive this partnership. Moving on, we look at on the other end of the spectrum, we have Razer, a fintech company, leading again a consortium. And what's really interesting in this partnership is that, you know, we have a wide range of partners from different backgrounds, including Sheng Siong, a very large supermarket chain in Singapore. We have Insignia, which is a venture capital fund, Carol, which is a online used car platform, and Insurance Online, all coming together to enable the consortium to leverage on each other's ecosystems. And moving on to look at Hong Kong, right? How have they done it? We have Standard Chartered, a very well-known and successful bank, who is actually looking to move into the lifestyle, the consumer space by partnering with telcos, travel companies to be able to create a differentiated proposition conventional banks. And then we have another example of how fintech companies can collaborate with banks. And this is how we have also seen that Xiaomi has come together with AMTD with the view to actually leverage on each other's strengths, be it the customer user base, or could it be the superior capabilities to analyze customer data to provide more market relevant driven solutions. Next slide. So I think the question that we should really be asking is not about why do we need to partner, but rather I think the more pertinent question is who do we need to partner to make this work. And the way we sort of look at this is to actually segregate it into two broad groups. We have a group of the banks, this could be the insurance companies, or simply the capital providers. And this could include the VCs, or perhaps just financial backers. And the right-hand side of the ecosystem, a whole range of parties have already expressed interest. And today, as we understand, more than 60 parties have already expressed interest to the central bank to potentially apply for a digital banking license. And who are these players? They come from corporates, e-commerce, telcos, they are tech providers, fintechs, or some who would be able to provide that last mile distribution kind of touch points. And ultimately, now why do we see this actually happening? And the next slide, what I'm going to share is a little bit about the MyBank case. And I think what it really shows that, you know, in terms of the key learning was that MyBank was clearly a very successful virtual bank in the world. And it has demonstrated that even within the second year, it was actually able to break even. And if we take a look at the other virtual banks globally, not many of them have been able to show that sort of profit track record. And if we were to step back and ask ourselves, right, what were some of the kind of learning lessons that we could draw on MyBank? So I think some people might say that China is a whole totally different experience, and it's a huge population, and MyBank succeeded only because they leveraged on Alibaba, only because they leveraged on Ant Financial. I think absolutely. I think what it goes to show us about the MyBank example was they were very quickly able to break the market because they were able to successfully leverage on the ecosystem that Alibaba had so successfully created across with their SMEs, with their vendors, with their customers, and starting with the payments solution to facilitate transactions. On top of that, with the huge amount of data that Alibaba had on the data, on the customers and on the merchants, they developed very strong technology capabilities to be able to analyze the customer patterns, be able to analyze the risk profile of customers, and use that to develop risk management tools and capabilities to come up with credit solutions to meet these unfulfilled requirements of both the SMEs as well as the customers on the platform. So MyBank was different because they wanted to target a very underserved segment, which was the underpenetrated SMEs, micro SMEs, basically vendors, startup companies who could not access financing. But they believed that with the data that they had, they could manage the risk profile by understanding how customers spend, and basically by evaluating the risk scoring through a different method, they believe that they would be able to better manage the risk. And this has been shown basically through the NPLs. I think on average, MyBank achieves an NPL about 1% compared to about just under 3% for the broader China. Next slide, please. So I think this case study, what I wanted to just to share was that even when you serve an under-segment kid, I think if we look at in Malaysia, many of the banks, I think, have been very, very cautious to want to approach this market. I think having very, very legitimate concerns that, you know, about the high cost of servicing the customers and what would be the profitability given the kind of time as well as the effort to service them. But I think what the MyBank case study shows that in order to make this work, what is absolutely critical is the speed to market. One of the key reasons why MyBank and WeBank were so successful is because they were the two early entrants in the market. They had a huge ecosystem of user base who were already using the platform. And because of that, we were able to achieve scale very, very quickly. And within the second year of business, as we can see from this slide, they were able to actually achieve a net profit. And this is something which is very, very different from what we see, for example, in Europe, the likes of the Monzos, Revolut, and so forth, starting on their own, trying to build their own brand, their own ecosystem, their own partnerships. If you have to build from a zero base, what it shows is that it will take a long time, whether it's 5 years, 10 years, and you will spend a lot of money on marketing, on branding, or on simply just the customer acquisition cost. It is really going to significantly outweigh your revenue. So I think that the key message that I would draw from here is the importance to build scale very, very quickly. And if you do not have the kind of ecosystems today, it definitely makes a lot of commercial sense to partner with others who have the existing ecosystems and leverage off each other's ecosystem so that you can build scale quickly in the market. So I think the concluding point of this message was that although they targeted an SME segment, they have also partnered very well with financial services banks. And today, MyBank, from an initial starting point of about 6 million SMEs in 2016, they are basically have achieved more than 20 million, and they are targeting 13 million SMEs by 2021, partnering with various banks across. So they don't provide all the financing themselves. In some cases, basically they act as a kind of an agent or bridge between the banks as well as the customers. So what it goes to show is that one of the key success factors is also the partnership between fintech companies as well as banks to leverage on each other's strengths. Next. I think from the case study and we looked at the partnerships across, I think, in Hong Kong and Singapore. I think what to me is evident is that the one who can find the quickest route to the market and who can build the ecosystem in the quickest way will be the ones who will likely succeed in today's competitive kind of banking market. What I've seen is also, I think, working across with looking at the experience of the e-wallet operators and having worked on a couple of projects is that, today there is about 50 to 60 e-wallet licenses in Malaysia, and many of the e-wallet businesses are made up of various partners, be it from telco, be it from the technology side, corporate. But if I may be very candid and honest, although the partners have come together, but I have not really seen many of them fully leverage or harness the benefits of their ecosystem. Although they have partnered primarily more from an equity or capital contribution, my observation is many of the e-wallet operators are still trying to make it work on their own. As a result, they have to incur significant customer acquisition costs, marketing, technology, staff costs, and this has been one of the key reasons as to why many of them are still basically in the growth mode. And I've spent a bit of time discussing this because I think ultimately one of the key areas that applicants will need to consider is that how do they demonstrate that pathway to profitability to Bank Negara? How do they show that they are going to be different from the other sort of tech startup players? How, if they were to partner with banks or other players, would they be able to overcome some of the challenges that the tech platform businesses have experienced in this part of the world? So, and what that's also really shown to me is that if you do this independently and starting from the days ahead could be long. And from our experience working on various sort of stress testing, looking at business plans, validating assumptions, even the best in class companies in this part of the world have taken about 7 to 10 years in order to be able to show an EBITDA positive or even a break-even position. And one of the requirements is in the draft framework was that Bank Negara has requested that participants show that within the 5 years, how will they be able to demonstrate their path to profitability? Is it going to take 3 years, 5 years, or is it going to take 7 or 10 years? So I think forming strategic and smart partnerships would be very, very critical if we want to get up to speed to the market and to be able to build scale very, very critically. And I think in conclusion, I think almost, if I may just summarize the kind of 3 areas that I'll be looking at, is one, is being able to be kind of pragmatic in terms of identifying what are the key success factors to make the digital bank venture work, and what are some of the barriers to entry. So if you're an applicant or a player, I think to be kind of quite honest about what are your current capabilities and what are some of the gaps that might need to be filled, and finding the right partners who can either provide you, whether it's that technological edge, whether it's that access to the underserved market, or basically it could be ecosystem, finding the right partners to help you to almost get a quick head start compared to the others in the market. And I think what's also critical is when you have found the partners and formed the consortium, is actually coming up with a very clear business plan in terms of who do you want to target, for your digital bank, right? which segment of the underserved, finding your niche almost, and what is the solution that you want to provide. And I think from the case studies that we have looked at, it is not sufficient or sustainable to provide a payment solution solely, or even a savings, for example, or deposit. And I think it's being able to come up with a range of products, profitable products to serve these target segments. What are the sort of credit opportunities? And microfinancing, if managed well, can become a profitable businesses, as we have seen in a number of countries. So I think being very, very clear in terms of your business plan, what is your operating model? How are you going to balance the kind of the risk and the reward structure? How do you incentivize management to achieve? And in a kind of typical M&A, we typically see earnouts to incentivize management to achieve those targets. In this case, it could be profitability targets after X number of years. And I think lastly, which is a kind of a real factor to look at, it's potentially what happens, if it doesn't work. What are some of the kind of potential trigger points or exit options that we have, in our consortium? And I think another critical question, which is often kind of posed to me, is that how then do we value our contribution of partners? And ultimately, if we go into a digital bank, would we be valued as a bank, or would we have the benefit of the tech valuation or unicorn sort of a valuation? So I think these are some of the kind of interesting questions and observations that we have seen in this and ultimately, I think it's about being prepared for the journey and coming up with if you like, a partnership playbook so that you are prepared for the process and you can seek to achieve that alignment between your partners and that you are clear in terms of what is your plan and the expectations of each other, be it a capital contribution or it could be a strategic contribution. And and preparing for all sorts of scenarios to mitigate as well. How in the event that you are successful, how do you share the returns and the rewards? But in the event that it is not successful, then how do you exit in an amicable way, at the same time being able to address the regulators' concerns? So that brings the close of my presentation. Thank you. And I will want to pass on to Michael now.
Thank you, Yennie. If I can invite Michael to give his incumbent thoughts.
Hi, good morning, everyone. I see we've got about 357 participants. So good morning and selamat pagi, everybody. I'm very thankful, very glad to have the opportunity to share some of my thoughts with you about digital banking. And if you go to the next slide, you'll see that it's relatively simple set of slides, but there are just a few key thoughts I wanted to share with you. No doubt the digital economy is flourishing, and obviously the pandemic over the last 3-4 months has sort of accelerated the move of many companies, banks included, to think more and more hard about the way they reach out and service their customers digitally. As I always like to say, necessity is the mother of all invention. However, the demand of customers, particularly retail customers, for more and more digital offerings and digital services from banks, insurance companies, stockbrokers, and wealth managers has been what we call a mega trend that started, I would say, since 2010, about 10 years ago. And that trend has been accelerating, meaning that expectations of these customers have changed, and they are now demanding that these financial services companies provide their services and their products online. So you'll see on the left-hand side of this current page that the ability to get your transactions done, approved safely and securely and instantaneously has become a hygiene factor. But more importantly, a lot more of the retail customers in particular are looking for instant approvals for new products. They will browse the web. They will look at the various offerings from different banks, different financial services providers. And when they find something that fits their needs at a good price point, they want to be able to press a button and get approval for that product instantly. It could be a credit card, it could be a personal loan, it could be an auto finance loan. And that demand, I think, is accelerating. And many banks, including Maybank, have been looking at how we can provide all of these on a straight-through basis, meaning you can get instant approval without having to get out of your house, start your car, drive to the branch, find a parking space, take a queue number, and then go and see a customer service rep who may or may not know the details of the kind of product that the person is looking for. However, the reality is that there are certain capabilities that are critically required. Number one, to be successful in providing these digital financial services, you need a simple to use yet beautiful user interface. You need a very strong value proposition, meaning that, for example, you won't be able to provide a personal loan online and charge a higher interest rate than a loan product that you can get from the branch. That just will not work. In fact, quite the opposite. Customers will expect a lower rate of interest. Customers will also expect continued engagement after the product has been approved. And this engagement needs to be contextually driven. And what does that mean? It just means that the interaction is not intrusive. It's actually triggered because there is something that is of importance to the customer. And finally, brand. The brand of the bank needs to address and be consonant with some of the values of the targeted customers that like to do digital banking, that like to purchase digital banking products. So issues like sustainability, social equality issues, or any trending issues on social media. These are some of the things that banks need to be aware of that will impinge on the attractiveness of their brand. The second thought I'd like to share, again on this same slide, is about the fact that data is now becoming the absolute bedrock for many business models. Previously, the assets of organizations that determine its success was very different. So if you think back 20, 30 years, banks were very proud of the size of their branch network. So if you wanted to take over a bank, one of the key things that bank will project to the buyer, the potential buyer, is the number of branches, because the number of branches is a proxy to the distribution reach of that bank. For insurance companies in the past, the number of agents was absolutely critical for them to be able to reach and service their customers. For stockbrokers, what was very important was the quality and the size of their workforce for remisiers. Now, all of you will know that these assets are now becoming less important. They still have a role, but increasingly in the digital world, the number of branches, the number of insurance agents, the number of remisiers who can take your order to buy or sell a stock are becoming less and less relevant, particularly for those who are embracing digital technology, digital services for financial products. Now, in this new era, data is at the heart of any long-term, sustainable, and scalable business model. If you don't have the data to be able to serve your customers, to anticipate what your customers want, data to be able to put together the right product and service offerings, you will not be able to sustain your profitability with your digital customers. The problem with many banks, many insurance companies, and many wealth managers or stockbrokers is that data, being at the center of everything they do, has never been in their DNA. They only collected data to be able to get applications approved or service requests fulfilled. This is very different from players like Amazon, Uber, Google, and many people have asked, how can venture capitalists and private equity funds continue to inject more and more monies into these companies when their P&L looks so terrible, so negative in many senses for many years? The answer is simple. because what these companies are doing, these new economy companies are doing, is not mining for transactions or mining for relationships. They're actually mining for data from every source possible. And they have the infrastructure, whether it's people infrastructure or technology infrastructure, to make use of it. So banks and insurance companies and other financial services providers, they need to be able to figure out how they can change their DNA. It's as fundamental as that. Change their DNA from looking at customers just purely as customers, rather than looking at how they can collect data to better understand their customers and to acquire new customers. If I could move to the second slide of my presentation. Now, all of you would have learned and heard of this word agile, the ability to deliver in an agile manner. And the reason why this is becoming critical, or is already critical in a digital economy, is that the pace of change is accelerating. So new competitors, new threats, new trends that actually impact the P&L will happen in quarters, not years. It used to be in the 1950s that a banker could sit around and rest assured that over the next 10 to 15 years, his relevance as a branch manager or regional director would never be threatened, because he or she would know all the customers in his or her region or branch area. Today, those customers that we have in regions or in certain branch areas, they can be taken away without the banker even knowing about it, and it can happen very quickly. Now, agility in all the documentations and articles that you may have read is needed not just in technology. Agility is needed in work practices, it's needed in processes, it's needed in the basic skills that the people working for banks and other financial services providers employ. However, we cannot escape the need for good technology. So IT enablers for very effective project work, agile methods, there are many types of them for delivery of new products, new projects, but also the culture of breaking down silos between departments, the culture of building effective cross-functional teams, even the simple topic of getting different people from different quote-unquote departments sitting together, talking to each other is something that contributes to agile. And these are some of the challenges, some of the issues that many banks are facing. And if you go through the literature, you'll find many case studies. And it's interesting because those case studies seem to indicate that agile is taking over as a way of working for many banks. The reality is that agile development, agile projects, these are all still very much a work in progress. And there are many, many banks that are still struggling because of the innate strength of the silo mentality that operates in banks that have been built up over the last 50, 100 years. Finally, the fourth point is about partnerships and ecosystems. I think one of the speakers before this brought this up. In the past, again, if you go back 20, 30, 40 years, banks basically went it alone, meaning they had a great deal of vertical integration, particularly for banking products and services. It's the same for insurance companies, it's the same for wealth managers and stockbrokers. However, these entities, these financial services institutions were seen only as banking service providers or financial service providers. Things change quite significantly over the last 8 to 10 years with technology enabling the emergence of players that could become major aggregators. So in today's parlance, we call them super apps. And the best early examples of that in China were WeChat and Alibaba. Alibaba had, obviously, all of you know, the DNA, the roots in a very successful B2B e-commerce platform. It became a B2C e-commerce platform. Then they launched Ant Financial. and financial services products became very important as an integral part of that platform that they built, not just to service China customers, but also customers across the world. WeChat started from a social media games start, but it moved into a lot of other things that impacted retail customers to meet their needs, and then finally financial services through WePay. And obviously the two of them have set up branches. So these super apps have inspired other players, namely Grab in Southeast Asia, which tries to be a super app in this region, but also other players like Facebook and Amazon, all of which, if you read the literature, are trying to expand very significantly from their basic roots to provide a lot of other different services. So that's why I call them major aggregators. Of all the different types of services they provide, they want to do what they can with their DNA in their areas that they know best, but also move into areas which are adjacent to their core areas. And interestingly, many of these players have decided to move into banking, to move into insurance, to move into wealth management. And this is because there are profits to be made by moving into financial services. For the longest time, many of these financial service providers have been earning very, very good profits. Some of you may think that they earn super profits. And the inherent business nature of financial services is digital. So it's very easy for some of these players to move into the banking area. So banks cannot sit around not doing anything. It is quite clear, and I can tell you that almost every bank, in fact, I would say every major bank, has got a strategy to build partnerships, to get into ecosystems. That's a big word, to get onto new platforms. And the aim is simple, to make sure that their products reach as many new customers as possible, but also to learn about the kinds of things and the culture and the work practices of the partners in the ecosystem. So this is something very new to banks. It's a muscle that has not been there for a very, very long time. And I think one of the speakers before me spoke about the fact that whilst they may publish intent to become partners, operationalizing the intent is a very different thing. And let me close off on the third slide about fundamentals. It's easy to get distracted. It's easy to get wowed by all the literature, all the articles that talk about the superb potential for digital banking. But success is not certain at all. Success in a niche for many of these digital banks does not mean sustainable success in the long term. There are many examples. Mint, Plaid, Bow, Moven, many of the neobanks in the UK and parts of Western Europe. I think Paul mentioned number 26. There's Atom, there's Metro Bank. All of them have built up a niche. But I can tell you, if you dig deeper, you'll find that many of them, even the ones that arguably have beautiful application interfaces and strong, compelling debit card, credit card, Forex type propositions, they're finding funding an issue. The ability to provide credit products, it could be credit cards or loans, is absolutely determined by the ability of that financial entity to secure long-term, cheap funding. And that's something that many of them are struggling with. And as you take a look at the life cycle, after about 3 to 4 to 5 years, many of these players are quote-unquote shake out, meaning they fail. So many of the banks, well, we look at them and we learn from these failures so that we don't have to pay the quote-unquote tuition fees. And it means don't be hasty. Be very clear about what is the strategy for the digital bank, who it serves, why would someone use it, and how would you scale. Now that leads me to my final point about being customer-centric. And this is obviously a word that has become, a phrase that has become very, very commonly used. But it just means that the bank needs to understand who is the customer, where is the customer, why would a person be a customer, what would drive a person to use that digital bank, and how do we leverage the bank's assets to monetize the opportunity. So I think without this focus as a very fundamental tenet of the strategy for digital banking, it will not be successful. I'll end there. Happy to take any questions that come up later. Thank you.
Thank you, Michael. Thank you, Paul. Thank you, Yennie, for those insights. I think I will jump straight into the questions, and we have plenty, a lot of which you have already addressed. But can I also say on the next page, there's a QR code. If you could scan the QR code to basically do the survey and get your CPD points. So let me jump straight in and ask Michael a question. Has the threat of virtual banks been overdone? For instance, at the end of the day, banks are possibly the most regulated industry there is out there. And will we end up seeing many of these players jumping into virtual banking be equally regulated in terms of capital requirements and, customer deposit, et cetera, et cetera? For Michael, please. Yeah.
Yeah, sorry, I was on mute. Thanks, Prakash.
And Michael, I actually also wanted to ask one final add-on question to that, which was basically, you mentioned data. Why have incumbents been so bad at using that data? Because Amazon and the likes of Alibaba have been around for a good decade and a half at least.
Well, those are two very different questions. So let me tackle the first one first. We actually don't see the emergence of digital banks as threats. We actually welcome them because I think they will be serving, well, this is quite public, they will be asked to serve quite different segments from us for the right social purposes, and I think that's great. But we look forward to observing the kind of offerings that they have and the kinds of ways they approach the market. Because as we know, for banking practitioners, banking is an industry where you could come up with something today and I can guarantee you that tomorrow we can copy it. So we're actually very happy that virtual banks can come in. We will be obviously closely observing. And we wish them well as they experience the joys of being regulated. I think that a lot of the things that we do in a banking institution, a lot of the costs that we incur is to meet the regulatory requirements of Bank Negara for the right reasons, because we need to be well regulated to provide the kind of confirmation that we are a trusted, solid entity that will be around keeping your deposits safe for the next 50 years. So we wish these new virtual banking providers all the best and to enjoy interactions with their respective regulators. On your second question about data, I think that is a really, really good question. And the answer is very simple. A lot of the players like Amazon, Facebook, Google, as I mentioned earlier, the DNA that they had when they started was oriented around data collection. However, the DNA of a lot of financial institutions when they started, and it could have been 50, 60, 70, 80 years ago, was not about data. A lot of it was about relationships. It was about the branch manager, even the VP, the senior VP, the president, knowing who their customers were, wining and dining, getting to know their needs, and then going back to the office, sitting down and putting a proposal to corporate customers, or getting together a project team to put together a product for retail customers. The DNA was not about collecting data about transactions, data about where people shop, data about the kind of daily interactions that individuals have. So when you build your core banking transaction systems not based on collecting data, you then end up with a spaghetti of systems with each one having different sets of data which can't be melded together. Very difficult to use. And I think that's part of the reason why, even though Amazon and the other players have been around for a decade or more, banks are just finding it very, very difficult to even use the data that they have, let alone try to collect more metadata, more broad social data from other sources.
Thanks, Michael, for that. For Paul and Yennie, which existing digital banking business model and structure, maybe a couple of them, which a traditional bank could look to as a case study to consider? I mean, and why is it their model and structure stand out? And are there any incumbents, globally that have already been successful in doing it or partially there, etc.?
So, Prasad, doing what? I suppose it's a very broad question there. In some respects, I think there's value in looking at overseas examples, but the characteristics of Malaysia in terms of market size, the metropolitan versus, regional sort of splits, and also the demographics make it really important to, I think, work bottom up. So, I think the Bank Negara has also set the challenge really, really high for a virtual bank by saying you need to service the underserved. They're underserved for a reason, and that's because they're hard to get to. You can't get data on them, or they don't actually have the money to make it viable. So in some respects, I'm thinking that to be successful in the Malaysian market, you need to have almost several different customer groups. And if you see that today, like you look at the DFIs, they have a social purpose, but going to Michael's point around raising the deposits and the funding is usually the constraint on their growth. So they'll be offering attractive term deposits. So their term deposit customers are very, very different from their social mandate customers. So I think that to be a virtual bank in Malaysia, to be successful, you're going to have to be a little bit broader than meeting the mandate specifically. Otherwise, I don't see any way of making it sustainable in the long term, because the underserved are not going to provide the deposits that allow you to lend. So I think that's one perspective on that. Yennie?
Right, okay. Thanks, Paul. Thanks, Prasad, for the question. I think when we looked at the models, how do you define success? One of the key factors I think would clearly be, is this a viable business, right? And I think the models that we have looked at, which have been able to show that kind of profit track record, are the two kind of Chinese ones, WeChat and MyBank, as well as Kakao Bank. But I would say what's really key is that I think there were a couple of factors. One was that getting up to speed, right? Having that either that experience to be able to run the bank, let's say in Kakao Bank, leveraging a little bit of their parent, understanding the kind of risk management, the processes, what it takes to run a bank successfully. And I think the second one is already having that kind of customer base now. So I think that is a very, very key driver, especially when we look at the financial modeling aspect, because in the early years, I think that the CAC, the customer acquisition costs, the marketing, we look at the tech costs, the staff costs, right? As you scale up your business, you'll find that the cost will just escalate and it will grow so quickly, even as you are trying to kind of build your presence and base in the market. So I think what's really key is that if you don't have that customer base, then figure out a way to kind of partner to get those customers on board so that you can reduce and manage your CAC significantly. The other point is to keep and manage operational costs very, very tightly. I think the literature has shown for the successful digital banks, they have been able to reduce their operational costs by about 40 to 70%. But I think in order to achieve that, I think a lot of these kind of fundamental building blocks have to be there. And in order to ensure that you would be able to grow your revenue faster than your costs at a certain point in time, whether it's after the year 3 or year 5, so that you will have a sustainable business model. And I think what's also underlying having a sustainable business model, as Paul mentioned earlier, is being able to serve, I think, a couple of kind of target customer groups. When we look at these underserved, or it could also be of the population having needs that are currently not met, right? I think having that segment of customers which will be profitable, it's going to be quite core. As is, targeting both not just the SMEs but also the retail side. And whether, I think that one of the questions that was posted in the group was whether is Malaysia sort of large enough, or do we have to look at other geographies? And to be frank, I think that is a very, very good question. My team and we have done quite a couple of the modeling of the market sizing. And to be very frank, I think when we do the modeling and we look at Malaysia, how small the population is, and it is definitely not easy. So I think ultimately it's about coming up with looking at who are you planning to serve, the volume of the user base, and as well as the revenue streams, the fees as well.
Are there any obstacles to delivering that sort of customer value proposition that is idiosyncratic to Malaysia itself, in your opinions?
Yeah, okay. So thanks, Prasad, for that question. So we also did a kind of voice of the customer initially when we were looking at the whole e-wallet proposition, and there were kind of interesting feedback that was actually received. And one of it was still general, the Malaysians' perceptions, whether it's a security concern in terms of the systems, are they secure enough? And particularly in a digital bank, will my money be safe? So the security of the systems is one. Secondly, what about my data? Is that, the threat of kind of cyber security, is my data going to be leaked or to be exposed to other parties? So I think being able to address that is going to be a very, very critical component. In order to gain the customers' confidence. Therefore, to me, it kind of makes sense for fintech players or other kind of corporate to try and partner with banks. I mean, the banks may have a kind of minority stake, but I think having the bank kind of gives that credibility. It gives the customers the confidence, that there is a brand and that there's a stability and that the right kind of structures will be in place. And I think the other point I think in Malaysia was the adoption of internet as well as mobile phone. I think we have a very, very high mobile penetration. If we want to access the underserved or the rural, we will have to be able to use a mix of both offline and online channels. I think in the first few years, we would not be able to go truly digital, because for the rural segment, I think there are a lot of other factors, not just that the smartphone or phone is used widely, but there's also the customer engagement, other kind of nuances that could be needed to serve that particular segment.
So, I mean, I was just wondering, does the regulator perhaps not mean a digital banking license, but a mobile banking license like an M-Pesa that does serve the underserved?
Prasad, if you look at the guidelines, they actually leave it open to have agency banks. So,
right.
Thinking about getting to somebody who doesn't have digital, 3G coverage, it's trying to service a group of people that have smartphones. It may be centered on either a government office or a convenience store or some sort of other network. So there's an opportunity then to build that agency network to service the more remote regions of Malaysia.
Right.
Just for example is also doing stuff over SMS, which is actually some interesting things. So it's not the look and feel of the European virtual banks. It's a very different model looking out of Africa.
Right. But I mean, to be specific to what you said earlier on about how Kakao, for instance, have managed to streamline these KYC processes. I mean, a lot of these underserved entrepreneurs in Malaysia are not licensed with SSM or a local council, likes of the nasi lemak vendors, the burger sellers. How do we then onboard such a segment, which, they could pose very high KYC risks? And how has Kakao perhaps done that,
Well, I think actually the same time frame as the virtual banking is, Bank Negara is also issuing guidelines on KYC, particularly around eKYC. In some respects, I think conventional banks will be the real winners of this, because if they can move away from having the onerous KYC, they can actually get a very big head start on the virtual banks. I think that the answer to your solution to your question around how do you actually get data on people that otherwise are undocumented or low documented in sort of the financial system today, it's looking more at behavioral and social profiling. So in some respects, an alternative model to credit scoring is to look at the reliability of your friends. And that's what has been done in China and South Korea, China examples more specifically. So if you're thinking, I'm working with a platform provider, I can get some third-party sort of view on your turnover based on your sales. I can get your customer profiles on whether you fulfill your promises or not, or whether you've got a lot of people saying you're late, you don't give good solids. It's actually taking a fundamentally different approach than what is the standardized sort of approach to credit scoring. And it goes back to, you know, Michael made the comment is he's welcoming the competition and he's going to look closely and see the good ideas. The only way I can defend myself if I'm a virtual bank from Michael is to have a data advantage, because that's the one thing he can't access directly. If I can get a better understanding of the customer behavior or data, then that's the one thing that's really hard to duplicate in the short term. He can have the same product, but if he doesn't have the oil in his terminology to run the machine, it won't work so well.
Well, which brings me to the question that if you do have to have these partnerships, you might end up, you know, it's going to be hard to manage across the board. Maybe too many cooks spoil the broth, that sort of thing. Michael, do you see the likelihood of partnering? I mean, I'm scratching my head as to why Standard Chartered, are partnering with the likes of Cable, PCCW, Hong Kong Tel, and stuff like that. Sort of makes more sense, but then a lot of the other partners bring their own baggage with them, basically.
Well, partnerships, and even when there is a mutual set of intentions that both partners or multiple partners are keen on, is already very tough. I think now if you find partners going after a value proposition that seems quite strong but unproven, I think it is indeed challenging. But most banks have already embarked on it. They are clear that there are benefits of partnering with telco companies, with non-bank FIs, with fintech companies. But the key is to ensure that the rationale for that partnership, whether it's an alliance or equity stake or joint venture, they need to be extremely clear. And I would also say that the other criteria is to ensure that the bank will be able to exit if it doesn't work out. Sometimes you can spend years trying to make something happen, and all you're doing is just spending a lot of management time. I'm not even talking about the investment monies. I think it's the management time and focus on something which is akin to trying to row against the tide.
I think
the
comment around Standard Chartered, I think what they've done in Hong Kong is actually quite clever. So if you think about Standard Chartered, it's probably got more of a weightage towards corporate institutional banking, business banking. It, you know, across its region and in Asia and Southeast Asia area, it's not in retail and all segments. And, you know, think about it's been playing with the idea of how much retail participation has in Malaysia in the last, 10, 15 years. By looking at this new segment with a new branding, it's actually accessing a totally different customer base than its corporate and institutional banking sort of foundations. And it can actually go to market in a very different way with different cost structure. So, Standard Chartered doesn't have the best cost to income ratio. So this is a very different complementary sort of challenger brand that they're building themselves. So there's actually advantages. And one analogy is I worked with Qantas, the airline in Australia. And you may also know they have Jetstar, which is their low-cost brand. But Jetstar is their second attempt. They actually bought a low-cost carrier called Compass, and they thought this is going to be great for serving the underserved, the regional areas. But they put the two together, and suddenly Compass looked exactly like Jetstar, had the same governance, had the same bureaucratic, had the same safety. So when they actually set up Jetstar, they actually set it up with a totally different governance model, a totally different course system. So you could not actually give frequent flyer status. And if you take the analogy of that, is there was no contagion between the historical model and the new model. And you see Jetstar has actually grown more than the base. So it's actually taken over the group. So, thinking about if I'm an incumbent, going back on Michael's thing, I think they have better fundamentals in terms of accessing to funding. They have better fundamentals in terms of being able to deal with the regulator and risk. Their biggest challenge is legacy systems and culture. And I think the third one is also around channel conflict. So if they can address those three challenges with a challenger brand or working in partnerships and having almost like a portfolio, then they would be the real winners.
Thanks, Paul. We've got to draw it to a close here. And basically, it looks like there are threats and opportunities, and that jury's still out in terms of being able to be profitable while, basically fulfilling the mandate of serving the underserved or the unbanked. So on behalf of everyone here, I'd like to thank Paul, Yennie, and Michael again for taking a valuable time to prepare and share such extraordinary insights with us. Thank you as well to all who attended and engaged with us. We hope you've enjoyed the discussions today. We do apologize that we were unable to accommodate everyone who had questions for the speakers due to the time constraints. But before we go, I'd like to reiterate how important it is to continue honing your banking skills and knowledge as we move into a new uncertain future. Find a suitable professional program as fundamental skills in the critical areas of banking will always remain relevant, even as we move towards digital banking. So after that soft sell, I would like to let you know that our next session on regulation and governance in digital banking will be held on the 17th of June, 10 a.m. In this webinar, Dominic Cheng of Risk Assurance Services Partner at PwC and Ting Tu Wai, Assurance Principal from PwC Malaysia, plus a representative from PIBM, will be joining as speakers in our ongoing AICB PwC Digital Banking Series. The session will discuss the requirements for regulation and governance in the digital banking environment, how each risk is different, the fundamentals of eKYC and recovery and resolution planning. Thank you again, guys. Stay safe and do visit AICB's website at www.aicb.org.my for updates on our upcoming webinar sessions. Many thanks again. Thank you all.